It's Monday, the 7th of October, and welcome to Stock Market Investing News. Today, I want to talk with you about slippage. Slippage in the stock market is a very important concept for you to consider. There's sometimes when you disregard it completely, and I'll explain why. There's other times where you want to pay very close attention to slippage in your trading, and I'll also explain when those conditions occur as well. First of all, what is slippage? Slippage is a situation where you look at the screen and you punch in an order and then you get a very different price from what you expected to get. And the market basically is known to have slipped against you. And so I was very fortunate that I was able to do a PhD at an extremely good school. And the Chicago Board of Trade sponsored the data for my dissertation in slippage in the futures markets. And I discovered that on average, slippage is mean zero. However, the dispersion of slippage, the variance or standard deviation, was extremely wide in cases where the market had very low liquidity. So if you've got an asset where people don't want to buy and sell it very much, then you're going to get hit with a lot more slippage. That's one thing I can guarantee you. How can you get an idea that you're going to be in one of those situations? Well, it's pretty simple. If you look at a stock and it has a really wide spread, you're going to get hit with a lot of slippage. That's right. So, a lot of people that go out and there buy these stocks that are trading for 0.0001 cent. Well, a lot of times if you look at the spread can be really massive if you're buying 1 million shares. And another thing too is that sometimes your commissions can be very high if you're buying 1 million shares. Right now, there's some offers running around of no commission trading, and we're going to see how long the brokerages that offer that service can continue doing it. And so as long as you do have a situation where you're not paying commissions on your trades, of course buying 1 million or 2 million or 3 million shares can be a perfectly great opportunity. And I certainly would say, yeah, don't turn it down. But if you're getting hit with slippage, it may not be as good of an opportunity as you first thought it was. And that's because if the spread, for instance, the bid between the bid and ask is really wide, when you buy, you're going to buy at a certain price, but then when you get out, you're going to find that it's really hard to get out at a fair price. And I've had that happen before. And so the way to determine whether or not you're going to get slipped is look at the difference between the bid and the ask. If you're looking at a stock like Apple, go look at Apple on Yahoo right now, and you'll look at the bid and you'll look at the ask, and you'll see there's not more than 1 or 2 cents difference. When we take a look at large New York Stock Exchange stocks, the average spread is like around a penny or so. So, look at your big stocks, your Apples right now, your Facebooks, and those kinds of stocks that have a lot of trading volume on them, and you're going to notice that the spreads are really narrow. And then go look at the stocks that people don't know very much and don't trade very much, and you're going to see really, really, really wide spreads on those stocks. I usually mention it when I'm looking at a stock and it's got a wide spread on it. I'll say, hey, it's got a wide spread. It's not very often in this particular news channel that I actually show you stocks that have wide spreads. And the reason is because I just don't trade them. And so since I don't trade them, I'm not very interested in it. And if I don't consider it a stock of interest, then I'm not going to actually show it to you on this channel. So that's the main thing I want you to understand today, is that slippage can be a problem. It's not a problem if you're trading large stocks on places like the New York Stock Exchange or the NASDAQ, if they're the largest stocks. Any of the stocks that are in the S&P 500 or in the Dow are going to usually have pretty tight spreads. If it's on the S&P 500 and it doesn't have a tight spread, that's a warning signal. I'm going to go in and look and see what the heck is going on with that stock. Why does it have that really wide spread? And that's the takeaway that I want you to have for today. Let's go take a look at what's interesting in the stock market and what it's been doing. Today I'm going to talk about the ETF IEF, the iShares 7 to 10 year Treasury bond. Then I'm going to discuss Teucrium sugar, and then wrap it up with the SPDR DIA Diamonds Dow Jones Industrial Average. So when we look at IEF, the iShares fund, you can see that because, I know this is really crazy, but it's like what's going to happen is if the Fed keeps reducing interest rates, it's starting to hit that lower barrier. You can't have interest rates below zero. So there is some sort of upward limit on this. And the best way to see that is normally by looking at a long-term chart. But we have to go way back in time to be able to see what's going on this particular stock, or actually on this particular market. And it doesn't go far enough back. But it's just hard to say how much higher the stock could actually go, and because interest rates have a lower boundary. But it's interesting that we do see ongoing bullishness in the interest rate market, and because of that I'm showing you this particular ETF. If you want to track what's going on, the relationship between the FOMC, the Federal Open Market, what's it called, Council, or whatever the heck it is, the Federal Reserve, when they go out and they mess with the interest rates, this is where it's going to show up over here. Okay, so the other stock that I want to cover with you today is the Teucrium sugar cane. It took a hard dump today, and the reason this is interesting is because I actually do have a small $5,000 test purchase on it. We can almost just go ahead and adjust this downtrend. The main thing to understand, and this is an ETF on a commodity, which is sugar, and it's coming off of these all-time lows. And if it is going to, even if it's going to rise, we're going to get some pretty hard kickbacks on this particular type of investment. And the main thing that I'm watching is that obviously I don't want it to be penetrating these prior key support levels right here. You know, if it starts stressing that, if it would even, I think, drop down pretty hard below this trend line, I'd be looking at getting out of the position and basically deciding maybe it was probably more in this level. I don't know. You know what? I don't plan, but if I wake up and it's weaker and I'm not sure why, then that's a pretty good reason why I might decide to get the heck out of it. The indexes are really important to pay attention to in the current rocky market. We had a good rebound on Friday, and then today it kind of weakened. Well, the market rebounded straight up, so I'm not surprised that it settled back a little bit today. And, you know, the news was that it's because of the trade war that this thing has settled back. Well, this was because of the trade war, the big drop here, the pullback today. It's hard to say whether it's because of the trade war or it's just kind of normal noise in the market. And that's what I got for you today. Have fun, and I'll catch up with you tomorrow.